If you're an owner-managed business, you're maybe a director of that business, and you're thinking, oh, I've heard that if you buy an electric car, then it's going to be really tax efficient. So if you're in that camp, yes, definitely watch this video as well. Maybe you've thought about, what about standard petrol and diesel vehicles? What about hybrids? Well, this video is going to explain everything that you need to know in order to make the right choices. I've really recorded this today because I've noticed a few of our clients rushing out, buying cars, not been talking to us about it. And some of those have led to costly errors. So I want to just really break it down into all of the kind of key aspects of things that you need to consider. So I'm going to kind of kick us off with, why does all of this matter? Why are cars important? Well, they're really important because there's VAT implications, corporation tax implications, and something called benefit in kind, BIK, sometimes people refer it to as a bit of a buzz phrase. The government want to see us moving towards carbon neutrality, and they've incentivised electric and to some degree plug-in hybrid, plug-in hybrid vehicles where you can drive a certain amount of mileage on pure electric as well. I think sometimes when clients are trying to decide what the right options are, they're kind of baffled by VAT, corporation tax. How does it all fit together, Justin? But it's not just that. It's not just the taxes. We've got a myriad of car choices out there as well. We've got these hybrid vehicles. What about ones that don't plug in? Are they still any good? And then you've got hire purchase, PCPs, leases. What does all this terminology mean, and how do we make sure we're making the right choices as business owners? I want to start today talking about a real-world example. So I took over a client, a previous accountant, had let them go out and buy a second-hand Audi TT. They'd only paid £5,000 for this Audi, and they were thinking, oh, that's great, we'll run it through the company, it's going to be great. No, it's not going to be great, because the benefit in kind tax, the personal taxes that we pay as directors, it goes off the original purchase price of the vehicle. So although they'd only spent £5,000 on that car, the original purchase price, or the retail price, which is the one that HMRC likes to use, was £35,000. The next stage of benefit in kind is it's linked to how much CO2 that car emits. And in this particular case of the Audi TT, it was 34%. What you effectively do is take the original retail price, multiply it by 35%, which gives you your taxable benefit, and then you multiply it by your tax rate. In this particular client's case, 40% taxpayer. We told them that they had a £4,760 tax bill. Really, really horrible situation to be in, and they were really cross with their previous accountants that they were allowed to even go down that route as well. I think another thing to emphasise as well, so we've talked a little bit there about personal tax, but using that Audi example, when it comes to corporation tax and writing off the value of the vehicle, that example of the Audi TT, it's actually because it's also linked to CO2 to do with the corporation tax legislation. We have these things called writing down allowances, and because of the CO2 in that example with that car, we could only write it down at 6% a year. That takes something like 43 years, or maybe it's 46 years, to fully write off the value of the vehicle against your corporation tax. And there was probably no VAT recovery to kind of go after in that particular case. So it really wasn't a great deal as well. From the benefit in kind point of view, I've talked there about the personal tax, but don't forget the company must also pay employers' national insurance as well on top of that. So in my client's case, they ended up with really quite a hefty bill. So you're starting to see with a real world example just how making the right choice or making the wrong choice can be really, really costly for you. The first question that you need to ask about cars is it a pool car or is it a company car? What's the difference, Justin, you might be asking? Well, the key difference is that a pool car is a car that's usually kept at the premises, the business premises, overnight. It's driven by lots of different employees. And, if it meets that criteria, wonderful, because there's a full VAT recovery on that vehicle as well. And if you're buying new, you can usually, and it's an electric vehicle or very low CO2 output, which tends to be plug-in hybrids, you can write the full cost of that off against your corporation tax. Clients like to be clever with me and say, well, just say I don't have business premises, so I just work from home. So can we not just say it's a pool car, but it stays at my home? No, it doesn't meet the criteria. HMRC are really, really strict on this stuff. If you're going to make a full VAT recovery on something like that and write the full cost off against being a pool car, and they don't want employees not paying benefit in kind taxes. So don't take the risk on pool cars. It's not worth it. Company cars, on the other hand, is where you're going to be doing a mix of both business and personal miles. So a pool car, you shouldn't really be doing any personal miles. In a company car, great. I have a company car, electric company car. I take the kids down to their swimming lessons, rugby club, all of that kind of stuff. But of course, I'm using it for business as well. I'm going out to see clients on a regular basis. So actually, that meets the definition of a company car. And of course, as soon as it meets the definition of a company car, we've got to be careful about VAT reclaim. It may or may not be able, in most situations, you won't be able to reclaim all of the VAT. In some situations, it will be none, and some of it, maybe 50% of the VAT, depending on what type of structure and deal we're going to take. More on that shortly. But again, remember that all benefit in kind taxes for company cars revolve around CO2 emissions. So this is why electric cars are really, really good, and it's why you need to make the correct determination. So that first question, pool car or company car, really, really important, and for most people, it will be a company car. What about new versus second hand? And also that what we've been talking, I've already mentioned CO2 output. What's all that about? Well, I think there's some really, really key factors at work here. CO2 emissions, whether the car is new or second-hand, it doesn't matter. The government have set out the tax rules based on CO2 emissions. So, number one, it doesn't really matter. Second-hand cars, on the other hand, we might be attracted by a much lower price of entry in terms of maybe buying a second-hand car. Second-hand cars will fall into this writing down allowance. We can't claim the full allowance of the vehicle, just full stop. A second-hand car, we can't claim the full write-off against the vehicle. It will either fall into these two writing down rates. One's called the special pool and one's called the main pool. Those two percentages are either 6% write-down per annum or an 18% writing down allowance. That is what's called a reducing balance. So the balance slowly reducing, which is why it takes quite a long time to kind of recover the full cost of the vehicle. And that Audi TT example I gave you, that 6% writing down, it's going to take a long, long time to actually write that vehicle down before it actually gets to a nil balance. Low emission cars tend to fall into that 18% writing down allowance, which is a much kinder rate. So it still might be worth your while looking at a second-hand car, as long as it's got really low CO2 output, which again, the best rates for benefit in kind are those either electric vehicles or the plug-in hybrids, really with a range of greater than 50 miles. Now, if we go for a brand new vehicle, and it's a low emission vehicle, which I think is 50 grams per kilometre or less of CO2, then it will we can write the full value against your corporation tax. Brilliant. It's 100% first year allowance, which is just absolutely fantastic, and that can provide fantastic tax savings for the company, and it's also very kind on a personal tax point of view. So what about personal tax on kind of these different types of vehicles that we're talking about? Well, on an electric car, it's a 2% benefit in kind rate. Absolutely wonderful. I've got a client, went out and bought a Tesla for £50,000. The benefit in kind, 2% of that vehicle, multiplied by their tax rate. They were a 40% taxpayer. It's £400 in tax for the tax year. I mean, it's absolutely tremendous, isn't it? As we start moving up and looking at plug-in hybrids with a reasonable electric range, of the kind of 50 miles or more pure electric driving, you're looking somewhere in that kind of 5 to 8%. But I did look at a client who had it was a self-charging, so it charges as it goes. Hybrid, still very efficient vehicle, but we actually found it was a 17% benefit in kind rate. So the government have made it very, very sort of stringent on that CO2 output, which is why it's really important for you to choose kind of these low emission vehicles. And of course, the benefit in kind tax rates do kind of play a big part in kind of choosing what vehicle we're going to go into. So, I've mentioned a little bit about, benefit in kind, that Audi TT example I started with, that £35,000 value. If we compared that to an electric car, for example, so imagine we had an Audi TT for £35,000, or we've got an electric vehicle for £35,000. The benefit in kind value would be £700 on an electric vehicle at 2%. So £280 in personal tax potentially for the tax year. Absolutely wonderful. Now, if that £35,000 vehicle is a gas guzzling petrol car, fell into 34%, well, that's £11,900 of benefit. And if we were a 40% taxpayer, that's where that £4,760 comes from. It's important to kind of understand on top of these kind of figures that I'm giving you as well, that these benefit in kind amounts factor into your taxable threshold, so it counts towards your total earnings. So if you imagine that you're getting a salary out of your company of 50,000, you think, what does it matter, 11,900, I can afford the tax. Well, actually, all of a sudden, that benefit in kind has actually pushed you into a 40% tax threshold. So it's really important for you just to kind of think about what impact that's going to have. And obviously, I've already mentioned is national insurance. You've got to pay national insurance. So in that example of the Audi TT, the client ended up with 13.8% employer's national insurance bill. That's an extra £1,642. The client all of a sudden is kind of, hang on a minute, I'm looking at close to kind of well over 6,000, getting on for £7,000 worth of tax on a car that cost me £5,000. This is madness, Justin. Yeah, it's madness, but this is why you've got to make the right decisions at the right times and make those informed decisions. And hopefully this video is getting you somewhere, although this is a really complicated area. So what about the purchase options? Does that factor into all of this? Yes, it does absolutely factor into all of this. So the first thing to consider is potentially an outright purchase. So let's say we've found an electric vehicle or an ultra low emission plug-in hybrid vehicle, and we can claim that 100% first year allowance against our corporation tax. Brilliant. The one thing I'm just a bit nervous about, just from a practical business point of view, is the crazy rates of depreciation that we saw over the last 12 months of electric cars. All of a sudden, lots of companies were going out and buying electric cars because they were becoming popular, and even employees in bigger businesses were taking these on salary sacrifice schemes. So suddenly there was a glut of cars in the market, and clients saw the huge depreciation rates. There are ways in which you can protect against that, and probably the first one would probably be a PCP agreement. They're slightly different. A PCP is like a personal contract purchase. A BCP, a business contract purchase. What you tend to find with a PCP, you've got lower monthly payments because there's a balloon payment at the end. But that balloon payment is usually a guaranteed future value of the car. And I've got a couple of clients at the moment handing cars back, and the dealers are, well, ultimately the manufacturers are taking some really big hits where there's not enough equity in the car compared to the finance that's outstanding, and that's their problem ultimately and not yours, and they've been protected from depreciation. Even one client of mine driving around a relatively modest electric car they've had for about 4 years, Renault Zoe. They were a relatively early adopter of the electric cars. The dealer's taken about £4,000 hit because they haven't got the rates of depreciation or hadn't factored those rates of depreciation. So PCPs can be really good. Do look at those agreements really, really carefully, because on bigger finance agreements, higher rates of interest, that can really cost you a lot of money in the long run, because you're always carrying that balloon payment as part of the finance. Usually what you find with PCPs is the manufacturer is keen to back the finance costs. So you find when you're comparing the cost of hire purchase and PCP, you notice that the interest rate on PCP is much lower. And that's because the manufacturer will know, or whoever the vehicle manufacturer is, that most people won't have the balloon payment at the end, and therefore they're more likely to buy another car from them. Whereas a hire purchase, you will own the car at the end, and sometimes people think, you know what, I'll just keep the car. So it's good. It's kind of it's good from your perspective, but also it's good from the manufacturer's perspective as well. But you do need to be really, really careful what you're doing with PCPs. They are exceptionally complex financial products. Do look at those T's and C's really, really carefully. I think just final thing on PCPs, just to talk to you about, there might be an opportunity to claim some VAT if it's bought through a PCP. Whereas on a hire purchase, that's probably not, or an outright purchase, that's not going to be possible. And that's because HMRC can see in certain situations PCPs as a lease arrangement. So that's a really good thing. Do just be careful again on a PCP that when you hand the vehicle back, that was your aim, to hand it back at the end, that you could be hit for damage charges and things like that. So do pay attention to things like excess mileage charges, whether there's a published tariff of damages, what you can expect at the end of the agreement. And some of those companies can have some quite excessive damage clauses in the contract. So just pay attention to that as well. Let's talk a little bit about hire purchase. Hire purchase, great products. Again, financial product, look at the interest rate. Do pay attention to those details, but you're going to ultimately own that vehicle outright at the end of the agreement. Of course, you're not protected against depreciation. And the other thing to bear in mind as well is to do with balancing charges as well. A balancing charge is a bit of a complex thing to do with handling capital assets in company taxation. But in simple terms, if we buy a car for £50,000 and then we hand it back 4 years down the line and it's worth £20,000, when you buy the car, you get the full relief on the £50,000, which is brilliant. But actually, when we sell it later or hand it back later, it gives rise to a balancing charge, and we need to pay tax on that £20,000. So what the tax benefit over the term is about £30,000. Company cars have been really, really useful, choosing the right product to manage corporation tax. So we've got this situation where your first £50,000 is at 19% of corporation tax, and after that we move into a kind of a marginal rate, which is an effective tax rate where you're paying 26.5% for every pound after that, up to about £250,000. So actually a hire purchase agreement or outright purchase of a car worth £50,000, if you had profits at 100,000, you could lower your profits all the way down, so everything's subject to 19%. So it can be really, really good. For some clients, they might be in a situation where they're like, hang on, Justin, I've got profits about 70,000. It would be better if I had an ongoing purchase or an ongoing car agreement, and that's where we would use a lease. Leases, you don't own the car, ultimately. It's not yours. But there's a funny little thing with leases where you can claim half of the VAT, 50% of the VAT, and of course there's no balancing charge at the end. But again, like all of these things I'm talking about, they're quite complicated financial arrangements. Make sure you understand the damage arrangements, any excess mileage charges on them. But the great thing is you've got that monthly cost going through your accounts, and it's lowering down things over time. Every deal will be different. I looked at some cars recently because my wife's looking to change her car. Walked into one particular garage and they were like, oh, we don't offer a business contract purchase. All right, okay. We offer a lease or an outright purchase or a hire purchase. Okay, that's their option. Then walk into another garage and they're like, oh, actually, we do it differently to that. And it's finding the car that works, the right financial product. What's the headline interest rate as well? That's going to kind of factor into things as well. So you just need to kind of think about these things as a kind of a key thing, basically. I think I've covered most of the things that you need to be kind of thinking about when it comes to buying a car. We've gone over, is it a pull car? Is it a company car? Kind of roughly what benefit in kind is. Some of the VAT stuff's in there. What types of financial products we've got. Ultimately, my view is that electric cars offer fantastic value for money. And there is going to be a slight increase in the benefit in kind, which is planned out. And so there's going to be like a 1% increase up to 5% benefit in kind. But even still, that's still exceptional value. So electric cars are a really, really good place to kind of start thinking about reducing down your tax bill. And also, I think one of the hidden benefits of company cars is your company is now paying for your car. It's not coming out of your own personal pocket. And it was wonderful for me when I switched into a company car. I owned my car, I sold it, and I was able to put a load of cash into my pocket, and the company bought the new car. It was, you forget about this as we pay for our cars out of tax money. So actually, it's to have a company paying for your car for you as well. So anyway, if you found that interesting, I hope you have found that interesting. And if you do have any questions, if you're one of my clients, then please just do get in touch with us. If not, I hope you found the video useful. All right, I'll see you next time. Bye.